So if you have any money in the market right now, a 401k, a brokerage account, anything at all, this video is for you. Because bond market is showing cracks. Fed started printing money again after 3 years of quantitative tightening, and institutional investors, they are already repositioning. Because right now in April 2026, something is happening beneath the surface of the financial system that most people aren't talking about. Something quiet, something slow moving. But when it breaks, and history tells us it always breaks, it doesn't break slowly. So today we are going to connect three dots that the mainstream financial media keeps treating as separate stories. Starting with our dot number one, the bond market. The $30 trillion foundation of the entire global financial system is showing serious cracks. And dot number two is the Federal Reserve has quietly started printing billions of dollars. And they are calling it something else, but we'll get to that. And dot number three is smart money is moving. So the institutional investors, the hedge funds, the central banks around the world, they are already repositioning. So starting with bond market, because everything else flows from here. Every mortgage rate, every corporate loans, every stock valuation on the planet is priced relative to treasury yields. So right now it is behaving like anything, but as of this week, the 10-year treasury yield is at 4.31%. The 30-year bond is at 4.88%. But the numbers alone aren't what's alarming. It's how fast they moved. And when yield go up, bond prices go down. That means holders of US government debt are sitting on losses. And it means the cost of borrowing goes up for everyone. The government, for the businesses, and for you and me. So three forces are driving this. First, the Middle East war. Since the US-Israel military action against Iran, oil has spiked to levels not seen since 2022. Oil drives inflation, and higher inflation means bond investors demand higher yield to protect their returns. And the second one is policy uncertainty. The constant reversals coming out of Washington are destroying trust in US financial assets. And foreign investors don't want to hold bonds issued by a government they can't predict. So when demand falls, yield rise, and that's just supply and demand. And the third one, this is the one that actually scared Wall Street. It's a liquidity crisis. So liquidity is how easily you can buy or sell an asset without moving the price. And right now liquidity in the treasury market has deteriorated so badly that market depth, the number of participants willing to trade at stable prices, has dropped by 40 to 50% in some areas. It got so bad that some major Wall Street banks shut off their automated trading system and priced bonds manually. In the world's most important financial market, traders briefly didn't know what US government bonds were worth. The MOVE index, which measures treasury market volatility, has spiked to levels last seen during the COVID crash and the 2022 rate shock. And Morgan Stanley called the market near an inflection point. Now this doesn't mean crisis tomorrow, but it does mean the foundation is becoming less stable than before. And when the foundation cracks, everything built on top of it gets more fragile, like stocks, real estate, your retirement account. All of it is downstream from this. And now here's where this connects to the Federal Reserve. Because the bond market stress and the Fed's action are not two separate stories, they are cause and effect. And here's the timeline. So from 2022 to December 2025, the Fed was doing quantitative tightening, shrinking its balance sheet. So from nearly $9 trillion down to $6.1 trillion over 3 years, pulling money out of the system. Then on December 1st, 2025, quantitative tightening ended. And immediately the Fed started buying treasuries bills again. $40 billion a month. They are calling it reserve management purchases RMPs. Powell stood at the podium and said that this is not quantitative easing, it's just a technical adjustment. Okay, let's look what's actually happening. The Fed is creating money and using it to buy US government debt. The balance sheet that spent 3 years shrinking is now growing again. And $40 billion a month is nearly $500 billion a year going back into the system. Now at first glance, $40 billion a month may not sound dramatic, but in financial market liquidity, direction changes before problem appears in headlines. Different level but same mechanics. And they are doing it because they have no choice, and here's why. Because the US has $39 trillion in debt, and every year the government has to sell new bonds to keep funding itself. But historically, foreign governments, China, Japan, were major buyers, and they have been pulling back from buying the US Treasury bonds. And domestic investors are nervous about inflation and they don't trust the government because of the policy and the thing the government is doing. So when treasury bond auctions don't attract enough buyer, yield spike as the government has to offer higher rates to fill the gap. But here's the trap. With $39 trillion in debt, the US cannot afford high rates. The interest payments alone would consume the entire budget. So the Fed steps in as the buyer of last resort. It prints money and buys the bonds nobody else wants, which injects more dollar into the economy, which causes inflation. The official CPI says inflation is 2.4%, but the M2 money supply, the broadest measure of money in circulation, grew at 10.6% in February. Prices follow the money supply with a lag, and what you'll feel in your grocery bill 12 months from now is being created today. They can't raise rates that would crush the economy and blow up the national debt. They can't cut rates that would pour gasoline on inflation. So they are frozen. The CME Fed Watch tool shows a 97% probability that the Fed holds rates unchanged at the April 29th meeting. The odds are similar all the way through September, and the Fed is trapped, and the only escape valve is more money printing, not less. So what do you actually do with this information? And here's the important thing. Smart institutional investors are not panicking. They are quietly repositioning, and 3 moves stand out. Move 1 is gold. So gold just crossed $4,500 an ounce and has returned roughly 65% over the past year. Nearly 4 times US stocks, more than 8 times US bonds. And JP Morgan is forecasting it hits $5,000 per ounce by the end of 2026. And this isn't just retail investors chasing momentum. So central banks around the world have been buying gold at historically elevated levels for 3 straight years. China, India, Turkey, they are all diversifying away from US dollar assets. And when the world's central banks don't trust the dollar, that's a signal worth paying attention to. And move 2 is shorten your duration. If you hold bond fund through your 401k or IRA, and many people do without realizing it, you have duration risk. When yield rise, long duration bonds fall the most. And shifting toward short-term treasury bills, ETF, treasury bill ETF, money market funds, or Shorter duration bond funds reduces that exposure significantly. Move 3 is think in real assets. Energy infrastructure, commodities, sectors that benefit from an inflationary environment rather than getting crushed by it. So when fiat money loses purchasing power, the things that hold real world value tend to hold up. And the biggest move of all, pay attention. The worst thing you can do right now is nothing. And the second worst thing is panic selling everything. Neither of those is a strategy. Rebalancing is stress testing, asking what happens to my portfolio if yield hit 5%, that's a strategy. So here's the final big picture. So the US government has two options. When this debt spiral reaches its limit, let the system break. That means depression, sovereign debt crisis, chaos. Or print enough money to keep it running at the cost of inflation and a weaker dollar. And history tells us government always choose option 2 every single time. So the dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. That's the Fed data, not a conspiracy theory. So if printing is inevitable, the question isn't whether your dollar will be worth less over time. The question is what you are going to do about it. And the bond market is cracking, the Fed is printing again, and smart money is moving. Now you know where and why. So I am Jack Cross, and on this channel we connect global events with your money and investments. Thank you.